Maya's SUV was 10 months old when a driver ran a red light and totaled it. Her insurer did exactly what her policy promised. It paid the actual cash value of the vehicle $19,000. One problem. Her loan balance was $24,500. Maya now owed $5,500 on a car that no longer existed, with no car to show for it. Nothing went wrong with her claim. This is how standard policies typically work, and it's exactly the hole gap insurance was invented to fill. Let's break down what it is, who actually needs it, and where it's cheapest to buy. A new car typically loses roughly 20% of its value in the first year, and a chunk of that happens the moment you drive off the lot. Your loan, meanwhile, barely shrinks at first, because early payments go heavily toward interest. Put those two curves on a graph and they cross late. For the first several years of many loans, you owe more than the car is worth, which is called being upside down or having negative equity. Your auto policy typically pays what the car is worth today, not what you paid and not what you owe. That difference is the gap. Gap coverage typically pays the difference between your insurer's actual cash value payout and your remaining loan or lease balance when the car is declared a total loss, whether from a crash or from theft. In Maya's case, it would have covered that $5,500 shortfall. What it generally does not cover is your deductible, missed payments, or extras rolled into the loan like extended warranties, though terms vary by contract. It only matters in a total loss. If your car is repairable, gap coverage does nothing, which is part of why it's relatively cheap. Gap coverage tends to make sense in a few specific situations. You put little or nothing down, so you started upside down on day one. You financed for a long term, like 72 or 84 months, which keeps you underwater longer. You rolled negative equity from a previous car into this loan, or your car is a model that depreciates quickly. Leases are their own case. Many lease contracts already include gap protection, so check before paying twice. And if you bought used with a healthy down payment, you may have never been upside down at all. Here's where people lose real money. Dealers commonly offer gap coverage rolled into your financing for a flat several $100s, sometimes $500 to $900, and you may pay interest on it for the life of the loan. Many auto insurers offer a similar protection as an add-on to your own policy, often for tens of dollars per year, not hundreds. Same basic idea, very different price. Availability and terms vary by state and insurer, and some carriers only offer it on newer vehicles. So ask your agent for a quote before you sign anything at the dealership. Gap insurance is not meant to be permanent. The moment your loan balance drops below your car's market value, the gap is gone and the coverage is typically doing nothing for you. A quick check twice a year takes 5 minutes. Look up your car's rough market value from a pricing guide, compare it to your loan payoff amount, and when the value is clearly higher, call your insurer and remove the coverage. If you bought it through the dealer, ask whether a prorated refund applies, because in many contracts an early payoff or cancellation entitles you to one. Quick recap, standard auto policies typically pay what your car is worth, not what you owe, and depreciation makes those numbers very different in the early years of a loan. Gap coverage fills that shortfall in a total loss. It matters most with small down payments, long loans, and rolled over negative equity, and it's often far cheaper through your insurer than through the dealer. Once you owe less than the car is worth, consider dropping it. Check your own policy and talk to a licensed agent about your numbers. If this helped, subscribe to Coverage Clarified for more clear, calm insurance explanations every week.